This episode is sponsored by National Debt Relief, a Better Business Bureau A+ accredited business with over 13,656 client reviews and growing daily. They can help you reduce your debt to a fraction of what you owe if you qualify. Get a free report comparing all your debt relief options at nationaldebtrelief.com/HTA. Friends, today we're going to talk about a word that starts with D that you're not supposed to discuss in polite company. Good thing we are not very polite company. Today we're going to talk about, yes, debt. Carrying some kind of debt is a pretty normal part of being an adult in today's society. Consider this episode as an introduction to the kinds of debt that you might encounter throughout your lifetime. What kind of debt you have affects your credit score, and your credit score is super important. It can affect everything from opening a bank account to buying a car to renting an apartment to even buying a home. Some employers even look at applicants' credit scores, so yeah, it's a big deal. There are some times when your credit score may need to take a back seat to getting out of debt, but we can talk about that in another video. All that said, you're taking a good step by learning how all of this works. For many people, deciding whether to take out loans to go to college for the first time can be their first big experience with debt and managing money. Depending on how much money your parents make and what kind of age you qualify for, you might get government subsidized student loans or private loans, which tend to have higher interest rates. You can take out student loans even if you don't have a credit history, and some loans let you take out as much as you want. But remember, the choice you make at the age of 17 or 18 might follow you for the rest of your life. Pros, you can go to college and making loan payments builds your credit history. Cons, if you take out too much or can't find a good paying job after college, you might be stuck paying off your student loans for decades. Defaulting on your loans, where you admit that you can't pay them, is a serious choice that can impact your financial future for the rest of your life. The other thing you should note before taking out student loans in the US is that it is extremely difficult to file bankruptcy to get rid of them. There are still many ways to try and make college a little more affordable, and we have a few videos on the topic in the description below. I didn't really have a strategy when I was 18. I wanted to go to a 4-year university right off the bat, but then I realized I can get the same education at a community college for the first 2 years for less than a fifth of the price of a 4-year university. Credit cards. Every time you use a credit card, you're taking out a small loan that you promise to pay back to the credit card company with interest. The most common type of credit card is unsecured, meaning it's not backed by collateral. If you don't pay your credit card debt, the company can't take your home or car, but it can try to sue you depending on how much you owe and what state you live in. Lawsuits are expensive though, so they usually try to settle before suing you. Pros, you can make purchases even if you don't have the cash in hand, and you're building your credit score if you pay back on time. Some credit cards also offer reward programs that offer things like airline miles, store discounts, or cashback. Cons, if you don't pay your credit card bill in full every month, you will pay interest. It can also be really easy to rack up thousands in debt and end up paying 2 or even 3 times as much as you originally borrowed. Medical debt. 43 million Americans have overdue medical bills listed on their credit report, according to a 2014 study from the Consumer Protection Bureau. Big debts from unexpected hospital stays can really add up, and unfortunately, unpaid medical bills do affect your credit score. There is a little bit of good news. In mid-2017, the 3 major credit bureaus, Experian, Equifax, and TransUnion, added a 6-month grace period for consumers to resolve medical debts before it appears on their credit report as an unpaid bill. It's not a solution to an ongoing massive issue, but it might offer some relief. Payday loans. These are small, short-term loans that usually come with really high fees and interest rates. Payday lenders are typically geared towards low-income people who are strapped for cash and need to borrow some money to make it to the next payday. ergo the name. Pros: low-income people can borrow money even if they don't have good credit histories. Cons: high fees and interest rates can trap people in a cycle of debt if they can't pay off the loans. Payday lenders are controversial and highly regulated in many states. Car loans. One of your first big purchases in life could very well be a car. Whether you're buying new or used, make sure that you've already checked with your bank or credit union to find what kind of car loan you qualify for before you go shopping. And make sure that you can commit to monthly car payments if you can't afford to pay for the vehicle up front. Look at the final purchase price of the car, not the monthly payment, to make sure you really are getting a good deal. Pros: if you pay off the car on time, you'll establish great credit history that will be useful for years to come, and you'll have a car to drive. Cons: if you sign up for a payment that's not realistic, you can find yourself struggling to make ends meet every month. And if you don't make the payments, you won't get to keep the car. Mike and Emma made a video on how to buy a car, so check out the link in the description. Home loans. Hopefully you've built good credit and saved up a lot of cash before you start looking to buy a home. When you're buying a home, you can usually expect to pay a small chunk of cash up front, a cash down payment, and the rest over the next few decades in a monthly mortgage payment that you owe to the bank that loaned you the money to buy the house. The more you can afford to pay up front, the less time you'll spend paying the mortgage and the interest and insurance that often comes with it. Pros: instead of paying rent, you're paying money into an asset that you'll eventually own, and hopefully it will appreciate in value over time, offsetting the cost in the long run. Cons: if you get into dire financial straits and get behind on your mortgage payments, the bank might foreclose on the home and take it back. Even in the best circumstances of home ownership, you should also expect to spend money on property taxes, homeowners insurance, and maintenance fees. Home equity loans. Let's say you want to take out a big loan to pay something major, like a home renovation, your kid's college education, or starting a new business. If the house that you're paying on is worth more than the amount of money you still owe on it, or you own the house, you can take out a home equity loan. Pros: these loans are usually low interest since the bank knows it can take your house if you don't pay the loans back. Cons: since the housing crisis of 2008, these kinds of loans are harder to get. You can also run the risk of losing your house if you don't make the payments. Debt consolidation loans. If you've got so many bills to pay off that you don't know how to deal with them, a debt consolidation loan might be an option for you. Consolidation loans are typically geared towards people with a lot of unsecured debt spread amongst different places, like credit cards, medical bills, or overdue utility or rent. As we learned a few minutes ago, unsecured debt means there's no collateral attached to it. A secured loan, like your house payment, isn't likely qualified for consolidation. So if you have a ton of unsecured debt owed to different companies, you might be able to talk to a debt counselor and seek a debt consolidation service that will help negotiate your loans into one interest rate and one monthly payment. Pros: you'll improve your credit rating and get fewer calls from collection agencies, and hopefully get on the path towards straightening out your financial life. Cons: you have to be very disciplined about your spending and pay the loan every month. If you're struggling with one or more kinds of debt we talked about today, you're not alone. For this series, we partnered with National Debt Relief, a Better Business Bureau A+ accredited company with over 13,656 client reviews from folks who were able to resolve their debt. National Debt Relief is a debt settlement company that will negotiate with creditors on their clients' behalf to reduce the amount of debt owed and consolidate it into a single lump sum. They're completely performance-based and charge no fees until their clients see their debt reduced. Their program is recommended for consumers who have over $10,000 in unsecured debt, and they offer a free savings estimate that can show consumers how much they can save with no obligation. Visit nationaldebtrelief.com/HTA to get a free report comparing all your debt relief options. See you next time for part 2, where we will talk about ways to get your finances back on track.
Very close.
43 million Americans have overdue million bills. Same thing. Before you start looking to buy a home. National debt relief is a debt. No, it's not a dad. See you next time on part 2, where we'll talk about ways to get your financial back on track. Nope.
Perfect.
Did it.
Yay! With 3 minutes to spare.
Hot dang.